Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Hello, I'm Michael Bull. Thank you for being with us today. Well, this segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com or reach out to me personally. Well, today we're talking about the hotel industry, the hospitality world. I'm calling the show Hotels 2020. And I don't know if that means the year 2020 or we're going to have 2020 vision. Maybe it's both, right? So, I think the hotel industry is very, very interesting for all of us in the economy and the commercial real estate world. We all can sort of relate to it. We all use hotels, but also they have daily occupancy. So what happens in the hotel world can sometimes be interesting to the rest of us with what's going on in the business world. Please welcome my first guest. It's Michael Bellisario, and he is Senior Research Analyst with Baird, and he's joining us on the phone. Michael, good to talk to you again.
Thanks for having me.
Well, Michael, you've you watch this world very closely, and you guys have just had your second quarter earnings. You've looked at the market. What are you seeing for performance overall in the hotel industry around the U.S.?
I think the simplest way to sum it up is that things are okay, but 6 months ago, 12 months ago, they were a lot better. Things have slowed. Growth is still positive, but on the margin, it's getting tougher to push rate, to grow occupancy further, and everything has slowed, and it's just a little bit more challenging today than it was 1, 2, 3 quarters ago.
Okay. So does that mean to us who love numbers in the commercial real estate world that you're seeing occupancy rates creep up a little bit, but not as much, and the same with daily rates?
Yeah, so year to date, supply and demand have actually been almost equal. So occupancy across the U.S. is pretty much flat. The call it 1.5% growth we've seen in RevPAR has pretty much been on the rate side. So 2% roughly supply growth, 2% roughly demand growth. So we're in the very low single digit range right now.
Okay. And are you seeing any difference, Michael, in the performance of the various hotels, like limited versus full service, versus maybe kind of the resorts and leisure hospitality type properties where we like to go relax?
Yeah, we've seen the leisure and luxury resort properties perform much better, and I think the main reason for that is the leisure traveler is strong and everyone has a job and everyone wants to travel. We've seen more of the urban kind of transient or business transient hotels, at least this year, underperform expectations, and I think a lot of that is due to CEO confidence and business confidence and people's willingness to travel and be a little bit more price sensitive. So yeah, we've seen the divergence widen a little bit, but the leisure traveler still very strong. The business traveler on the margin incrementally softer.
Yeah, well, that's interesting because it seems like there's a lot of confidence in a lot of the business people I deal with, and there's good consumer confidence, but so business travelers maybe not so much, huh?
Yeah, and you listen to the news and everyone on TV, right? There's always something to worry about. China, interest rates, something. Yeah. But I think what we have seen is just a general reluctance of people to travel, especially when it's not needed. It certainly feels like the business travel today versus 6 or 12 months ago. It's on a more the travel that's being done is done because it has to be done, and that will maybe continue to slow. But I think it all starts from the top down. What are the CEOs seeing? How are the businesses performing? And when you think about airlift and hotel demand and kind of the entertainment bucket of the expense line items, that's one of the first things that gets cut.
What about technology, Michael? Is technology impacting it? I mean, there's better technology, better video technology all the time. Is that having an impact on the business traveler?
On the business traveler, maybe a little. You can argue they're maybe booking their rooms a little bit differently. I think if you take a step back, technology in the hotel industry, it's really impacted pricing. You think about consumers, whether leisure or business travelers, they just have more information than they have ever had. All the different apps at our fingertips, the pricing transparency. We have better websites where you can review hotels and compare them. We didn't have that 10 years ago, 15 years ago, and it's just making consumers more price sensitive, or maybe just more price conscious. And it's a lot easier to switch hotels today and go next door instead, because you can see what you're going to get, what the ratings are, what the reviews are. So I'd put Airbnb in there as well in terms of the technology changes. There's just alternative accommodations, VRBO. People have more options, and technology improvements have enabled all that to occur.
Yeah, and it makes sense. A more informed consumer, they demand a better pricing in their stay. And you mentioned Airbnb. What is the impact there? I know there in the, I guess, early years of it, it was a lot of concern, but it seems like the hotel business has kind of done okay. I mean, it seems like, you tell me, has it really been affected by Airbnb?
I think the answer is yes. It's hard to prove and pinpoint exactly how much, but you look at demand levels across the U.S., occupancy levels, they're at record highs. Would they be higher if Airbnb didn't exist? Sure. But the one thing that's hard to tell is, of the however many million nights that are at Airbnb, how many of them are induced nights? How many of them are new? And that group wouldn't have traveled to Phoenix, Arizona for a weekend if Airbnb didn't exist. So it's hard to tell, but it's certainly having an impact. And I think the biggest thing that's helped hotel owners is the municipalities and states that have implemented legislation and new rules and laws around what you can and can't do. So you've seen a cutback a bit in inventory and the rate of growth slow, and that has certainly helped hotel owners and operators be able to manage their inventory a little bit better. But on the margin, it hasn't been good for hotels. It's impossible to measure, but that second derivative has clearly slowed from probably its peak in 2014, 2015 into 2016. That was kind of peak Airbnb from a hotel perspective.
Okay. From a consumer perspective of my own, the few times I've stayed in Airbnb, it was kind of just okay, and I didn't get that level of expectation that I get from a nice hotel. You kind of know what to expect, and you're more comfortable with it. And speaking of kind of more interesting places to stay, if you will, the boutique hotel, that's kind of been a growing market, right? What do you see there, Michael?
Well, it's interesting you bring that up, because you kind of put that in the same category of Airbnb in changing customer preferences. We've seen the big hotel brands, Marriott, Hilton, and Hyatt, they've embraced this. They've introduced new brands, new soft brands, Autograph Collection, Unbound, Curio, to name a few. And it allows owners to keep the property if it has a very unique local feel to it, but to be able to latch on to the Marriott platform, the reservation system, the loyalty program, and benefit that way. So you've seen the brands embrace it. That segment has grown very quickly for them. And I think in a world, from a consumer perspective, where you have still very cookie-cutter brands at times and more brands, the independent or independent-like hotel that might be affiliated with a brand, you feel like you have a much more unique experience, and you're not going to have the same experience when you go from Pittsburgh to Philadelphia, for example, or to New York. So I think that category will continue to grow. Consumer preferences are continuing to tilt toward customization and uniqueness, and I think that category has legs still.
Yeah. Well, again, from a consumer point of view, I recently stayed in a boutique hotel, and I did find the experience nice. It was kind of taken care of like you'd expect from the brand, but it was very local, and it was very cool. You could tell before they got in there and renovated it, it might not have been a place I would even wanted to stay. But when they got through with it, boy, it was really interesting. And we've had interest rates drop just recently with the Fed dropping their rate. Have you seen that impact the hotel industry, and what do you see for values trends right now?
Yeah, well, it hasn't helped the hotel REIT stock prices, that's for sure. It's helped the other real estate subsectors much more that are viewed more defensively and have longer lease duration. The rates going down has hurt hotel stocks more, just given that people assume growth is going to slow and the hotels will get impacted more. But in terms of what we're hearing and seeing, the spreads remain tight, and if anything, debt costs have just gotten 25 or 50 basis points cheaper for private equity buyers that use leverage, and that makes the cash-on-cash returns for them that much more attractive, and that puts them in that much more of an advantageous position when looking to acquire properties or companies. So if anything, the lower interest rate environment has helped. It's also helped with developers. Costs have continued to rise, but this cost, the interest cost and the carry there, has come down a little bit too. So it's still too early to tell what kind of the long-term effects are, but the low interest rate environment broadly for the last several years has certainly made the higher yields of hotels that much more attractive for some of the levered private equity buyers out there today.
Yeah, well, it makes sense. We're talking with Michael Bellisario with Baird about the hotel industry. And Michael, what do you expect moving forward? We have an election coming up. We have tariffs. We say coming up in a year, but we have the scare of tariffs. We have an economy that cycle that's has been a great 10 years. What's your forecast? What's your crystal ball say about forecast moving forward?
Going forward, I think it's going to be a lot more of the same. Slow growth, maybe slightly slower growth. And as we think about what are the upside risks versus the downside risks over maybe the next 3 to 5 years, I think the bigger risk is to the downside. It's just, when does that happen? And do we have a small pullback or do we have a pretty severe pullback? And I think that's when we talk to investors and management teams, that's the hardest thing to underwrite, is not only when does it happen, but what does it look like? And I think everyone still remembers 2008, 2009 pretty clearly, and that doesn't necessarily have to happen again, but slow growth, slower growth going forward, and greater risk to the downside than the upside is how we think about the world today.
Okay. And what do you see, Michael, for new supply, the trend there? And as you're talking to people in the hotel world, are they concerned with construction cost, and is that impacting their operations or their new supply in the market?
Yeah, I think the one silver lining that people have is supply growth is plateauing. It's moderated, and we've kind of hit this 2% level, and it doesn't really seem to be moving too much higher from there. And a lot of that is because projects are bigger, they're taking longer to get done, and costs are going up, both materials and labor. So as long as the economy holds firm and we have a shortage of construction workers, you're going to see supply continue to be positive, but it's probably not going to tick up from the level where it's at now, and it's more concentrated. It's in certain urban markets that you might not have seen the same supply last cycle, and they're bigger projects too. So it depends on the market, but overall for the total U.S., it's going to continue to plateau, and if anything, maybe over the next couple of years it ticks down a little bit, just because costs keep going up and projects just aren't penciling like they used to.
Yeah, no, it makes sense. Well, Michael, before I let you go, where might there be some opportunities right now? Are there any certain markets or property types that you see that, or might be some opportunities out there?
In terms of markets, I think one of the most interesting trends kind of relates to the tax cuts and where people and where companies are moving. Right, they're moving to more favorable states and cities from a work-life balance, from a tax perspective, both personal and corporate. So we've seen this move to Florida and Georgia and kind of the broader Southeast into the Southwest, and I think that trend is pretty powerful. It's still early days there because we're only 2 years into this tax cut. But assuming the tax code stays the same way, I think we'll see that trend continue. More migration from the high tax states like California and New York to more of the better work-life balance in tax-friendly states in the Southeast and Southwest, and I think that's a pretty big demographic trend that as it gains momentum, it's going to be much harder to turn that around if it ever does turn around.
Okay. So geographically, that sounds good. What about property type level? Are there opportunities in repositioning some of these hotels or changing brand names, or where do you see some other types of opportunities?
It's interesting. When we talk to people about value add, there's not a lot left to be value added this cycle because it's already been value added. Mm-hmm. But when we think about what the next several years look like, slow top line growth, challenging expense environment, the properties that have the most upside are the ones that are broken if you can find them, but it's the full service hotels, it's the ones that have unprofitable restaurants, golf courses that have 36 holes where you could probably slim it down to 18, the ones that have more optionality that aren't just rooms only product like a select service hotel might be. Mm-hmm. So that's where we see the most value creation opportunity over the next, call it 3 to 5 years if you're looking to deploy capital, just because you're not going to get it on the top line growth, and the cost structure is more challenging today than it has been earlier this cycle. So you got to find the other levers to pull to be able to create value, and a lot of that's coming from non-hotel things outside the rooms, and you get those at more the sprawling luxury resort full service properties.
Yeah. Well, that sounds good and sounds like a lot of fun. Michael Bellisario, thank you for joining us, sir. Good information as usual.
Thanks for having me.
If you'd like more information, check out their website. It is RW Baird. It's Baird. And stay with us. We'll have more on the hotel industry, and including some tips for buying and selling and for renovation of existing hotels. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.